All right, class, this is chapter 4, and we're going to talk about forms of business ownership. Let's go to the review. So here are some learning outcomes that you should know when you are reading chapter 4 and reviewing the PowerPoint slides. This table talks about the forms of ownership in a business organization. There's a sole proprietorship, partnerships, and corporations. Now, a sole proprietorship is a business that you're starting by yourself, such as Kendrick Kim, DBA, Evergreen Real Estate Group. So for my real estate company, when I first formed it, I did a sole proprietorship where for tax purposes, I reported my taxes like a personal account. The sole proprietorship is something that is myself as a doing business as, and at the same time, I pay taxes as an individual. The drawbacks for a sole proprietorship, however, is the legal liability. Unless I have some insurance to cover that, if someone were to sue a sole proprietor, legal theory would be that they could go after everything from the business and personal assets. Then there's partnerships, where you could form a partnership where you could divide everything 50-50 in terms of profit, sales, and expenses. As a sole proprietor, you make all the profit, but also you make all the losses as well. And then under corporations, there's two different corporations. There's a C corporation, sort of like the Facebook, where you offer stock, and there's double taxation under a C corporation. Or you work the corporation like an S corporation, where it's almost like a sole proprietorship, but you have the legal protections of a corporation, where if someone were to sue you, they could only go after, in legal theory, only go after the corporation and corporation assets, and they cannot come after your personal assets. Under sole proprietorship, they could come after your entire personal assets as well as your business assets. This is just a table that you should take a review. Here are some concept checks. Partners. Something of questions that you want to take a look at is, why do you want to partner? And what are the talents and skills does each person bring to the table within a partnership? How are you going to divide the responsibilities, the expenses? And you have to also consider, do you guys gel well? What I mean by gel well is, are you guys in sync, right? Do you guys collaborate and have the same common mission, goals, ethics, similar ethics and values, maybe even similar directions within your business? That is very important. And you also want to talk about maybe a partnership agreement in terms of laying out everything that goes into that partnership, in terms of how the expenses are divided, how the profits are divided, what are the responsibilities within each individual within a partner. It could be a partner of 2 people. It could be a partner of 3. It really depends on you and how you want to form that partnership. I recommend looking at the Small Business Administration government website to kind of take a look at some of these information about forms of business organizations. And I would also maybe look at the IRS. What are some of the tax consequences and how you form each of these organizations, such as either a sole proprietor, a partnership, or a corporation? So here's a video I'd like to show you about the sole proprietorship. And just when you're looking at this, think about what are some of the advantages and disadvantages of the sole proprietorship.
If you're the only owner in your business and haven't formed a business entity, then you are a sole proprietor. What this means is that there is no legal distinction between you and your business. You are one and the same. Not only are you your own boss, but there's no fee or process to form a sole proprietorship. All you have to do is start making sales. One thing that you will need, however, is a DBA, doing business as, if you want to use a trade name. This usually ranges between $10 and $100 depending on the county your business is located in. When it comes to tax responsibilities, if your business ends up owing more than $1,000 at year's end, the IRS requires you to make estimated quarterly tax payments in addition to your annual income tax return. Another nice aspect of sole proprietorships is that they don't have any ongoing maintenance implications or responsibilities to worry about. That said, one of the drawbacks of being a sole proprietor is that you have no protection. You are held personally liable for any debts and obligations your business should incur. This means your personal bank accounts and even your home residence can be used to satisfy these debts. But hey, at least you get to be your own boss, right?
So this is a quick book information about sole proprietorships. I highly recommend going into SBA.gov, the Small Business Administration, looking through the different forms of ownership, and also looking through IRS. The reason why I say that is you want to get a good bookkeeper, CPA, something accountant that can really tell you what are the tax consequences and legal protections that you may have related to your form of business ownership. Here's some concept checks again related to partnership. And this is a table that relates to the articles of incorporation. The Secretary of State, www.sos.ca.gov. So www.sos.ca.gov. That is the Secretary of State of California. You may want to look through there to kind of review what the articles of incorporation would be when forming a corporation or even a partnership, LLC, and how are you going to utilize that for your business and how to incorporate, whether in Southern California using the sos.ca.gov website to look at a template for the articles of incorporation. Some of the organizational structure of corporations, when you have stockholders, directors, and top management, and your president, vice president, treasurer. This is more of stockholders. You're thinking about C corporation. You might want to review the difference between a C corporation and an S corporation, looking through the IRS.gov as well as the SBA, Small Business Administration, and the Secretary of State, sos.ca.gov, to review how to incorporate yourself and what is the difference between these two types of corporation. This is a good table that discusses the advantage and disadvantages of a sole proprietorship, partnership, and corporation. This is not limited to what's on that list, but again, I really highly recommend you refer to the websites I had mentioned earlier. And also talk to your tax person, your CPA, bookkeeper, accountant related to this tax consequences of these types of forms of business organizations and how does that work. You may want to consult a business attorney that could talk about the different forms of these business organizations and what are the legal liabilities and the advantages and disadvantages of those legal liabilities and the protections based on the form of the business that you take, whether it's a sole proprietor, a partnership, or a corporation. And here is the advantages and disadvantages continued. Take a look at this. It is in the textbook, but it's also in the PowerPoint slides that were provided to you. Now here's a video on partnership. I want you to take a look at this, and it kind of discusses what a partnership is. And you may want to take some notes, but also review the video again from your PowerPoint slides.
Anytime two or more people run a business together for profit, it's an official partnership. In a partnership, each partner is considered to be one of the business's owners. Partnerships are generally pretty easy to set up. There is no fee or process to form a partnership. You just need a partner and to start making sales. You'll also need a DBA, doing business as, if you want to use a trade name. This usually ranges between $10 and $100 depending on the county your business is located in. And lastly, a partnership agreement is recommended in order to minimize conflict or confusion down the line, but not required. One of the advantages for being in a partnership is that you get to enjoy tax benefits, since the profits and losses of the business pass through to each of your personal income tax returns. Tax responsibilities include, in addition to your personal annual income tax return, you and your partner or partners are responsible for making estimated income and self-employment tax payments once a quarter. Additionally, the partnership itself will need to file an annual partnership return. Another nice aspect of partnerships is that they don't have any ongoing maintenance implications or responsibilities to worry about. Thankfully, partnerships are pretty easy to run because each partner is personally liable for the debts and obligations of the business. In other words, there is absolutely no protection for you should you get into a legal situation. So keep that in mind as you form your business together.
Okay, let's move on. So on this question here, on your own, maybe list some of the advantages and disadvantages in a partnership in terms of sharing the load. And when you make note of this, keep it for your reference. So when you make a decision of how you're going to run your business, review that, right? Remember, when you start a business, you're thinking of long-term goals. So your business idea will always adapt to changes and trends. So keep that in mind. What you write is not always going to be set in stone. Here's another concept check regarding corporations. This is something that you might want to review in your reading for chapter 4, and you also might want to review in your PowerPoint slides. Remember to click on this hyperlink of short video and longer video when you're taking a look at the video on corporations. Okay. Now, let's take a look at this video right here.
A C corporation is the formation of many large and small businesses. If corporate formalities are followed, the owners of a C corporation will enjoy limited liability protection. Forming a C corporation is a bit more involved than some other entities. You'll have to file articles of incorporation. This requires a fee around $150 and some paperwork filed with the state. You'll also need to identify a registered agent, which can cost between $40 to $60 a year. The purpose of a registered agent is to provide a legal address where there are people available during normal business hours to facilitate the legal service of process being served in the event of a lawsuit. Some other requirements include electing directors, issuing stock certificates to initial shareholders, and even creating corporate bylaws during the registration process. C corporations have a rigid set of taxation responsibilities. For instance, C corporations are employers by default, so you will technically be an employee. Because of this, you'll need to file monthly payroll deposits your first year and abide by all other employer-related rules and regulations. Unlike S corporations, your C corporation will also need to file quarterly estimated income taxes. After taxes are paid, any income left over and dispersed to shareholders as dividends is taxed again when the shareholders pay their personal income tax. Some states require a minimum annual franchise tax for all C corps, even if your business is not profitable. As you might expect, a C corporation can be rather high maintenance. A few of these ongoing responsibilities include holding annual shareholders meetings and periodic directors meetings, as well as maintaining detailed records of what these meetings consist of, known as recorded minutes. Keeping detailed financial reports of income and shareholder dividends. Filing separate income tax returns and maintaining a total separation between the corporation and its owners. While they are more complicated to run than other business entities, C corporations typically provide the greatest level of personal liability protection if corporate formalities are followed. This legal protection is perhaps the C corporation's greatest attribute.
Okay, let's move on. Now, you want to take a look at the difference between S-Corp and C-Corp. Let's play this video and listen in.
Hello everyone, so today we're going to be quickly defining and comparing the differences between C corporations and S corporations. So a C corp is the most common type of business entity in the United States, as it is a separate legal entity set up under state law that protects owner assets from creditor claims, also known as limited liability. A C corp is a separate taxpayer with income and expenses taxed to the corporation and not owners. If corporate profits are then distributed to owners as dividends, owners must pay personal income tax on the distribution, creating what's known as a double taxation. So money is taxed at the corporate level and then at the personal income tax level. Now, a simple example, consider a small business that has the following earnings, and they're the same for years 1 through 3. They have a business tax rate of 30% and a federal income tax rate of 28%. So they earn $1 million. Their cost of goods sold is $850,000. Their gross profit is therefore $150,000. They have another $50,000 in operating expenses. So they have EBIT, or income from operations, of $100,000. Now, tax on this at 30% is $30,000. So their net income is $70,000. And the assumption is for this small business, $50,000 is paid out as a dividend to the owner. So you deduct $50,000 and $20,000 goes to retained earnings, right? So they get taxed at the corporate level 30% or $30,000. Now, on the personal income tax form, so now we take those earnings, assuming that this individual does not receive any other type of salary or income from other sources, they receive $50,000, and so they pay 28%, their personal tax rate, on that $50,000, which is $14,000. So after-tax earnings from all of this money that flowed through the entity, starting at when they first earned revenue to when it was paid out, is $36,000. And so this is done for all 3 years. Okay? Now, the advantages of C Corps are limited liability, unlimited growth potential, and the ability to sell equity to raise money, and that's why most public companies are C Corps. There's no shareholder limit, so there's no limit on the amount of shares that can be sold to the number of people, and you have the ability to enjoy tax-deductible business expenses. Now, the disadvantages of C Corps are the double taxation. That's the big one, and that's why I really made this video, because it remains a challenge, as many owners seeking to be paid through dividends from the business will pay extra. It's also more expensive than an LLC or a partnership. There's increased regulations and formalities, and that's a steep learning curve, especially for small business owners. And there's no deduction of corporate losses for personal tax returns, because that's done at the corporate level. So there's no flow through, right? So that's why it's a separate taxpayer. That's the big takeaway from C Corps. Now, with S-Corps, once you've incorporated, you can elect S-Corp status by filing a form with the IRS and with your state, and as it is more attractive for small business owners. Once applicable, the profits, losses, and other tax items pass through the corporation to you and are reported on your personal tax return. So the S-Corporation does not pay the corporate tax. So this is considered a flow-through entity. The S-Corp is not a separate taxpayer like the C-Corp. It is a flow-through entity. The risk is that owners report their share of profit and loss in the company on their personal tax returns. In addition, there is a limit of 75 shareholders, which can be a challenge if the company considers raising money through a private placement. So that's really the big downside to this. That's why a lot of public companies, or really all public companies, are C Corps, because there's a limit of 75 shareholders. Because if there wasn't, then everyone would be an S Corp, really, because there's so much tax benefits related to really being a flow-through entity. There, of course, would be logistically complicated with thousands of shareholders to all reflect, the flow-through status. But again, theoretically, it would be a large benefit. So consider the same business. So the business has a tax rate of 30%, but they don't pay that 30%, and the federal income tax rate on the personal income tax form of 28% is the same, right? So no tax is paid at the corporate level. So we make the same amount of money, $1 million. We pay cost of goods sold of $850, gross profit is $150,000, operating expenses of $50,000 are deducted. So our income from operations, or EBIT, is $100,000. That's really also our net income because we don't pay, right? So that flows through. All of that money goes to our personal tax form. Okay, so then on our personal tax form, we have earnings of $100,000 for this year. And the assumption here is also that there are no tax brackets. But I just wanted to simplify it, right? Because with tax brackets, probably your tax percentage tax rate would increase between the two examples. But in this case, assuming the same 28% tax rate, taxes on this $100,000 would be $28,000, right? So after tax earnings is $72,000. Right? So the advantages of the S-Corps are limited liability, the same as C-Corps. The key benefit is pass-through taxation, thus eliminating the double taxation on distributions, the ability to raise capital by selling shares, so the same thing except there's a limit, and a once-a-year tax filing requirement versus quarterly filing for C-Corps. So that logistically also saves time for you. Now, the disadvantages are you must be a U.S. citizen and a permanent resident, unlike the C Corp or LLC. You have a limited amount of shareholders, so the maximum of 100 at the national level. In some states, it's 75. It depends on this. So I would recommend that you check out the laws, and sometimes they change. Also, closer IRS scrutiny and high ongoing expenses, and tax qualifications can be terminated if mistakes are made. And so, because you're eligible for S-Corp status, there's much more scrutiny from the IRS. So you need to be careful, properly file your tax returns, and if you do make mistakes, you can get penalized by being taken away. So that status is taken away and you convert back to a C-Corp. So the difference between the two, both C and S Corps offer limited liability protection, both require articles of incorporation to be filed, and both compromise shareholders, directors, and officers. There are lots of similarities, but they differ in the realm of taxation and corporate ownership. C Corps are subject to double taxation, while S Corps are pass-through tax entities. In addition, there is no limit to the number of shareholders for C Corps, which is most public companies, whereas there is a 100 shareholder limit for S Corps. So comparing those two examples that we looked at, so again, the same business, but in this case, paid at the corporate tax. There's a corporate tax and a personal tax, whereas with the S Corp, there's only a personal tax, right? So the after-tax earnings for the C Corp is $36,000, and the after-tax earnings for the S Corp is $72,000. Now that does this incorrectly reflects it because we still have retained earnings of $20,000. So a better way to look at it is the amount of tax that's paid. And that's how you should really compare your two alternatives. How much tax do I pay, which is cash going out of the business and really out of my ownership between the two cases. So with a C Corp, you pay $30,000 at the corporate tax level, and you pay $14,000 at the personal level. With S Corps, you don't pay at the corporate level, but you pay $28,000 at the personal level. So the difference, so really the combined taxes paid for the C Corp is $44,000, while for the S Corps it's only $28,000. So that's a real cash savings, a difference of $16,000 that you saved for this respective business, for really $100,000 that was earned in EBIT. Right, so that's a real benefit for the owner, and that's why S Corps are considered very beneficial for small business owners. Other than that, if you have any questions, I do recommend that you check out a lot of online resources. But if all else, you can comment below, and I'll be sure to get back to you as soon as possible. And if you did like the video, please like and subscribe to the channel for more. Thank you so much, and have a great day.
Okay, from this video, the author kept saying EBIT, E-B-I-T. What that means is earnings before interest and taxes. EBIT, earnings before interest and taxes. Okay, let's move on. Here are some questions to consider. And this is something for your own reference that you should write down and think about when you're starting a business. And think about how you're going to form that business based on your business idea, whether you're going to do a corporation, a partnership, or a sole proprietorship. Here's some concept checks. Here's an interesting chart related to top 10 franchises. Right? Remax LLC is a real estate company. Quite honestly, I'm a little surprised this is on here, a real estate company, but the source from this ranking was from 2017. And on the right, it tells you the initial investment that it must take to be part of the franchise if you choose that route. Here are some more top 10 franchises. And what are the minimum investments? Another chart continued. Remember, these are from 2017. So I would definitely take a look at franchises, an updated version of what are some of the franchises out there in 2022. Franchises are like you are buying the business with that name, and as a franchisee, someone who takes over a 7-Eleven or gets into a 7-Eleven business, they will help you set up systems the 7-Eleven way, right? If you want to learn more about franchises, look it up in the Small Business Administration, and you could also Google the word franchises, and it tells you information about franchises. I will try to look for a video related to franchises, and I'll post it in the modules. Here are some tips for purchasing of franchises, something that you should take a look at. And here's some more concept check. And here's the information of the question, the pros and cons of buying a franchise.
Did you know that in 2018, there were over 759,000 franchise units that generated over $760 billion in sales and employed over 8 million people? My name is Tarek Johnson, and I own 2 franchise locations that are 2,400 miles apart from each other. And in this video, we're going to have an honest conversation on whether you should buy a franchise. First, let me tell you what this video is not. This video is not a solicitation or sales pitch for you to invest in any franchise or business. Deciding to invest in a franchise could be the biggest decision of your life. And in this video, I'm going to cover exactly what I believe you must know about owning a franchise from a franchise owner's perspective. Before we get started, go ahead and drop me a comment below and ask me any question that you have about the franchise process. I do my best to respond to all the comments personally. Also, give this video a like down below and subscribe to the channel. I'll be posting videos every Monday, Wednesday, and Friday, sharing with you my learning experience of owning my 2 franchise locations, as well as having worked with over 1,000 clients personally as a financial advisor and traveling the country as a speaker for Tony Robbins. So let's get started. So number 1 is, why do you want to buy a franchise? Are you looking to replace your full-time income and leave a full-time job or corporate job and own a franchise to completely support your family? Are you looking to just create an additional income stream and have something for retirement, or just create a part-time income and find somewhere that you can invest your money in? Or are you looking to build real wealth and try to get rich from owning a franchise? When my wife and I made the decision to invest in our first franchise, it was going to be a significant investment. And the reason why we were deciding to invest in a franchise is because I eventually wanted to leave my work as a financial advisor, and we wanted to do something that was going to put ourselves in the best position to have an existing income stream that was already going, so that way when I made the transition, we would be in a really strong position. Deciding your why on why you might want to buy a franchise will literally affect every other decision that you make along the process. It will decide what type of franchise that you invest in, whether you're going to wind up being an absentee owner or be active in the business, what industry you're going to get involved in. Are you going to get involved in a service-based industry? This is going to decide everything for you, and it's really important to be very clear about what your objective and why you want to own a franchise business. Number 2 is money. So the average franchise costs about $250,000 to get up and running. And look, that is a very important number to think about. Obviously, if you're looking to open something like a Taco Bell or McDonald's or KFC or Burger King, you're going to be on the higher end. I mean, franchises can range from $10,000 all the way in the millions of dollars to get open. And that should scare you because people have lost a lot of money investing in franchises, investing in the wrong type of franchises, investing in the wrong brands, and not running them well. So money is something that you really have to think about. And ultimately, your financial situation will really determine what direction you can go with franchises. Most franchisors have a net worth requirement. They require you to have a certain amount of liquid money as well as a certain net worth in order to even qualify to be able to purchase one of their franchises. There are cleaning businesses that are as little as $10,000 to invest in. Those are likely going to have less of a net worth requirement. But keep in mind, the lower the cost of the investment for the franchise, the more effort and work you'll likely have to do on the front end in order to get that franchise up and running. So if you invest in that cleaning franchise as an example, you'll probably have to hit the ground and network and door knock and prospect and do all these things in order to get customers for that franchise business. Now, if you don't have any money to invest, then I've actually made a video on exactly how you can invest in a franchise with no money. So I'll link that up in the description below and go ahead and check that video out. Guys, the last thing to cover about the money part is that investing in a franchise is a really, really serious decision. As I mentioned before, there are people who have lost a lot of money. They've lost their life savings investing in franchises because they didn't know what they were getting into. Going into step number 3 is thinking about buying an existing location versus a new location. The reason why this is something really important to consider when thinking about if you should buy a franchise is because if you buy an existing location that already has customers, already has sales, is already generating a profit, then the likelihood of you succeeding goes much, much higher because you have all of those things in place and you're usually paying a price for the business that's based on the amount of profit that it's generating. So as long as you don't come in and screw something up or there's not major competition that opens up, then it's usually going to lower your risk and put you at a better position in succeeding. Now, when you're talking to a franchise company, you should ask them if they have any existing locations for sale. Oftentimes, they're not going to volunteer that information because if you think about what a franchise company is really interested in, oftentimes is they want to get new locations opened up. When franchise companies talk a lot about growing same store sales or same unit sales, then they're really focused on increasing the sales for existing franchisees. And that's when you know that a franchisor really has the best interest at heart for existing franchises. Now, the other option is that you can invest in a new location. And so obviously investing in a new franchise location carries a higher amount of risk associated to it because you don't have any customers, you aren't established yet, you don't have any staff, you don't have any processes, and you don't have any operations. Now, there are benefits to opening up a brand new location. You might be able to lock in a really good location for your business that's in a really great area. There might not be any competition in the area that you're looking to open your franchise in. So you really have to weigh the pros and cons versus opening up a new location or buying an existing location. When my wife and I opened our first franchise location, we were really nervous about it. I mean, it cost around $300,000 to get that first location opened. $300,000 is obviously a really big investment. So what I did was I was really strategic about the actions that I took and the way that I thought about the process of us opening, and we were actually able to become profitable our second month in business. So in less than 60 days, we were able to turn a profit in our franchise. This was huge in helping to alleviate some of those fears and those nerves that we had around the franchise business and made us feel a lot better about the decision that we made. If you're interested in knowing how I actually got the business profitable in 60 days, I documented that entire process and created a free 7-step blueprint to how I became profitable in 60 days. I'll drop a link for that below too. It's totally free. Make sure you grab it. It'll be really helpful whether you own a franchise or a business that isn't a franchise, because those steps are applicable to any type of business. So one thing to mention about existing locations and the immediate cash flow that they provide is that there's also another really big benefit in potentially buying an existing location. And I'm going to share that with you in step number 5, so make sure you stick around for that. Okay, number 4, and if you should buy a franchise, is you. Now, what do I mean by that? The most important aspect to you succeeding in a franchise or failing in a franchise is you. Now, when I say that, think about it. It starts from the process of selecting the companies that you're looking at and possibly investing in. It starts with the questions that you ask, the process that you go through, the due diligence process, the research that you do, the location that you pick. Ultimately, the constant throughout all of that is you. If you have a track record of not being able to make good decisions, then that might affect your ability to succeed as a franchise owner. And when you're putting up a lot of money to get involved in a business, then you really need to do a self-analysis and a gut check to really make sure that you are going to be up for the challenge. Now, another thing to consider is what your skill sets are. It's really important to make sure that you're aligning a possible franchise opportunity with the skill sets that you currently have. Now, does that mean that if you're planning on opening a food franchise that you have to know food and be good at food? Absolutely not. My background is in motivational speaking and financial advising, and I have 2 juice bar businesses. I had no background in that whatsoever, although I was really passionate about a healthy lifestyle and making juices and smoothies and different things like that. What I did have a strength in was the financials of a business, operations, and really finding and recruiting talent and managing that process. So I felt comfortable in owning a franchise because I'd be able to follow the system. So another thing to think about is, can you handle your lifestyle potentially getting disrupted? Franchises and owning a business is filled with challenges. I mean, if you own a business right now, then you know what I'm talking about. A crazy story that happened was the day before my wife and I were getting ready to leave and move across the state. In the middle of the night, someone broke into our business along with a number of other businesses in our shopping center, shattered the windows. I mean, just made a mess. It was a crazy situation. Stuff like that may not happen often. Hopefully that never happens to you, and it might not ever happen to you. But our life was completely disrupted for those 2 days. And then my life was completely disrupted for the next few weeks, handling the insurance claim and the process and all the things that happen as a byproduct of that break-in. If you're used to the normal comfort of a corporate job where once you leave your job, you get to put it aside and you're not really disrupted at home, then really thinking about investing in a franchise is something that you have to take a really deep look at, because it's possible and likely that your normal and current lifestyle will be disrupted in some way. And so the question really becomes, is the rewards that you'll get from that franchise worth the lifestyle disruption that will occur? And when I say rewards, I don't just mean financial rewards, because even if you make the same amount of money that you're making in another job or in another business, if you have the freedom and flexibility to be able to set your hours and spend more time with your friends and family, or go on more vacations, then that's a benefit that you really can't attach a number to. And it's a very intangible benefit. But it's really important to note that there's likely going to have to be some sacrifices made if you do own a franchise. And it's not just a life of glamour. There are a lot of real challenges. It's not anything that's sexy, and it could take you a number of years before you see the fruits of your labor really kick in. Okay, number 5. So I know I said before that number 5 was going to be a really important topic. I actually forgot something, so I'm going to move that to number 6. So make sure you continue to watch, and I'll tell you it in step number 6. Number 5 is following the system. So when you buy a franchise, the whole point in buying a franchise is that you are buying the name, the process, and the system. And you really have to be a person that is okay with following the rules and the system. If you're someone who really doesn't like to be told what to do and doesn't like authority, and I don't really want to use authority because a franchisor, you don't really want to see them as an authoritative figure. But if you're someone that doesn't traditionally follow the rules and likes to do things on your own and really kind of thinks outside of the box, then maybe buying a franchise isn't for you. Maybe you should start your own business instead, because the whole point of buying a franchise is following the system. And if you don't follow the system and you start doing things on your own, it's possible you can get in trouble with the franchise company. You can get fined or even sued. I've known franchise owners who started to break the rules with the franchise company, and they really refused to stop doing it and really got themselves in a bad situation with the franchisor. Then things just really aren't good from there. So it's really important to make sure that you have the ability to follow the system, follow the process, and if that's not something you're interested in, then you should not buy a franchise. Now, that doesn't mean you can't be creative and use your own ideas and your own talents and skill sets. Obviously, you're owning your own business, and so every day you're going to have to use your own strengths and your skill sets in order to make sure that that business is successful. But you're doing that within the operations of the system and the processes that are used. Now, what I would recommend is talking to existing franchisees within the system and asking them about how flexible and how open the franchisor is to new ideas that franchisees come up with, and implementing them into the business. So number 6, and the last thing that you should consider when thinking about buying a franchise is, drum roll, your exit strategy. Now, real quick, if you're still with me, make sure you hit like on the video and subscribe to the channel. It really helps other people see this information, and I'm going to be putting out really amazing content around franchises, franchise ownership, and again, what I've learned and the mistakes that I've made. So in thinking about your exit strategy, I'm a firm believer that you should be committed to whatever you're doing. When people aren't committed, that's oftentimes when they fail. But it's important to think about an exit strategy with a franchise because you're owning a business, and number 1, you're not going to live forever, and number 2, things could go wrong and changes could happen in your life where you either want to sell or get rid of the business. And it's really important to think about what that looks like and start with the end in mind, because that will help determine what decisions you make in even buying a franchise or in how you run the franchise during the time in which you buy it. So do you plan on receiving an income for as long as possible with the business and then selling the business at that point, or passing it down to a child or a grandchild or a family member? Do you plan on getting the business profitable or growing profits and then trying to sell the business? So it's really important to think about what your exit strategy is with the business, because again, that's going to drive your decisions that you're making. So what happens if the business isn't going how you planned it? What if you don't like it? What if you're not succeeding? What if you aren't making money? These are all things that you have to think about when buying a franchise so that you can be prepared and equipped to handle those situations. One of the things that I would highly recommend is to take a look at either existing locations within that franchise that you're looking at or within that industry and see what they sell for. What are they priced at? What are they priced at based on the profit margins that they're making? What are they priced at based on how much it costs for those locations to build out? Oftentimes you'll be surprised that a lot of franchises have really poor resale value. And so if you plan on only having the franchise for a few years and selling it, you could put yourself in a position where you're losing a lot of money. This is one of the things that is really, 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 really important to think about is your exit strategy and what's your plan. And the more research you do on the front end, the more you're going to be prepared on the back end. So guys, thanks for sticking it out with me all the way to the end. I hope you enjoyed this video. Go ahead and share it to someone who could benefit from it. And again, make sure you leave me a comment on any of the franchise questions that you have, and I'll make sure to do my best to respond to them personally. I'll see you in the next one.
Okay. Now, after reviewing this video, you hit the copy video URL, and you can listen to it again. All right. So that's just some key factors and concepts about franchising that you should know. Here are some questions to consider. Some concept checks. Let's take a look at this video.
It is possible for market competition to be reduced through corporate mergers. Not all mergers are anti-competitive, though, and some are even efficiency enhancing. Let's take a look at 3 categories of mergers. 1. Conglomerate mergers are mergers between companies with unrelated output. For example, in 1967, the Campbell Soup Company acquired Godiva Chocolate. Did this merger affect competition in the soup market? No. Did it affect competition in the candy market? No. Conglomerate mergers do not reduce competition in either market since the products are unrelated, so the U.S. government allows them. 2. Vertical mergers are input-output mergers. This means that a firm that produces a product merges with a firm that produces a resource used in the production of that product. For example, what if that soup company acquires, say, the company that makes the cans that the soup comes in? This is actually cost reducing, i.e. efficiency enhancing, because among other reasons it cuts out the cost of the middleman. The soup company doesn't have to continually renegotiate contracts with the can producers. Because vertical mergers make production more cost effective, the government typically has no problem with them. The one exception would be if a company was trying to acquire the sole producer of a resource, since that would result in a monopoly in the product market. For example, in 1999, there were 2 major competing bookstore chains on the East Coast, Borders and Barnes & Noble. Barnes & Noble put in a bid to acquire a book wholesaler, Ingram, but the government rejected the request because Ingram was the only major book distributor on the East Coast. Approval of the merger would leave the competitor, Borders, without a distributor, effectively driving them out of business. The government rejected this merger because of the monopoly that would result from it. 3. Horizontal mergers are mergers between companies that sell the same output. These are the mergers that undergo the greatest scrutiny by the government. If the merger doesn't noticeably alter competition in the industry, it's approved, but if it does affect competition, it is rejected. There's a big difference between 2 small companies, say each has a 1% market share, merging, versus 2 large companies, say one has 15% and the other has 25%, merging. The government uses industry concentration data to evaluate merger requests. The Herfindahl-Hirschman Index uses the sum of the squares of each firm's market share, or the 50 largest firms if there are more than 50, to measure industry concentration. For example, if the industry is a monopoly, then there's only one firm, which has 100% of the industry. So H equals 100 squared, or H equals 10,000. Thus, 10,000 represents the highest possible index number, or the highest level of industry concentration. An industry with 2 firms, each having 50% of the market, would have H equals 50 squared plus 50 squared, or H equals 5,000. What about an industry with 100 firms, each having 1% of the industry? Then H, the sum of the squared shares of the top 50 firms, would be 50. A Herfindahl-Hirschman index of less than 100 indicates a highly competitive industry. An HHI below 1500 indicates unconcentrated. An HHI between 1500 and 2500 is considered moderately concentrated. And an HHI above 2500 indicates a highly concentrated industry. 2500 is the U.S. threshold for mergers. One potential weakness in using the HHI is that the index can vary based on how the applicant defines the industry in the request for merger. For example, in 1997, McDonnell Douglas and Boeing merged. You would think that, being the 2 largest aerospace companies in the U.S., such a merger would be rejected, But the companies argued that the applicable market was global, not just domestic, so that foreign companies constituted part of the market in question. Thus, the Federal Trade Commission said that Boeing's acquisition of McDonnell Douglas would not substantially lessen competition or tend to create a monopoly in either defense or commercial aircraft markets, and the merger passed the industry concentration hurdle.
Okay. Hopefully you found this video helpful in regards to mergers and acquisitions. Here are some questions to consider. Some concept checks. And that's the end of the slide. Now, hopefully you have these slides for your review that summarizes chapter 4. However, this is, if you click from beginning of slide and view it as a slideshow, you could hit the videos and embedded hyperlinks to go to the section. But also in the textbook from OpenStax, you could see all the materials there. If you have any questions, feel free to connect with me. Send me an email or a Canvas message. And hopefully those chapter outlines and the chapter PowerPoints are useful to you in terms of understanding the concepts for week 4. Thank you for your time, and I look forward to hearing from you. And if you got any questions, feel free to contact me. Thank you.